Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, Thoughtful Money's spring online conference was held this past weekend, and I'm delighted to say the event was a real success. That was due primarily to the amazing lineup of speakers who presented and took live audience Q&A throughout the insight-packed 11-hour day. For those of you who didn't attend, I thought you'd enjoy hearing some of the conference highlights. The day started with Lacy Hunt, former senior economist to the Federal Reserve, explaining how when an oil price shock slams into an economy as vulnerable as ours was right before the war, well, nothing good results.
One of the most essential aspects of an oil shock is that it's a global event. It's not a domestic event. Oil is critical in every major economy's production function. And so when supplies are withdrawn and prices rise, there have to be major recalculations. And with oil and related products, it's very difficult for simple adjustments to be made because oil has price inelastic demand. They're not very good substitutes. So if you go into the gasoline station and the price is up and you don't like it, and your tank is empty, over the short run, you have very little that you can do to avoid the impact. The key factor that one has to take into heavy consideration is that the shock is not the only thing that matters. The initial conditions matter. And so you have an unsteady or teetering economies, and the supply curve shifts inward, point number 6. And the net result of that is that it's going to raise prices and lower GDP.
Luke Gromen then made the case for a pronounced stagflationary recession ahead, expressing his substantial concern for the economic damage the current war in Iran is inflicting on the highly indebted global economy.
It's going to be a crisis that'll be worse than COVID and '08 combined.
Wow, sorry, bigger than COVID and what combined?
2008 combined.
2008, okay, that's all right. All right, that's not a small statement.
No, this
Okay.
people, the gap in perception versus reality of this is as big as anything I've seen in my 30 years in research. Like reminds me so much of 4Q07, where what we were hearing on the ground in the seat I was in at the time was so bad that I was calling friends and loved ones saying, make sure you have under $100,000 in the bank under the deposit limits at that time, because there's gonna be a lot of banks failing next year. And at the same time, I was making those calls. The S&P 500 was hitting an all-time high. And people were like, oh, everything's fine. And I think this gap in perception versus reality is even wider.
Ed Dowd echoed Luke's recession concerns, though with a more deflationary bias, noting that the war's high oil prices are already creating a liquidity squeeze across essential supply chains.
This oil price shock is causing a liquidity problem across supply chains. And if you look at the chart of the U.S. dollar, it put in a nice low about a month ago. It's putting in a monthly swing low, and it's at 100 now. So as we roll through time, we expect the U.S. dollar to catch a bid and be a lot higher by the end of this year. That'll be indicative of a liquidity problem, a dollar shortage as credit defaults rise and supply chain issues magnify.
Michael Howell came on to explain that now that global liquidity is deteriorating, that is highly correlated with lower asset prices ahead.
This is a 5 to 6 year cycle. It's a cycle, as we would argue, which is about debt. It's a debt refinancing cycle. And that's an important thought to hold. And basically what you've got now is liquidity conditions are starting to deteriorate. They're coming down. They're not falling in absolute terms significantly yet. This is much more a slowing of the growth rate, but nonetheless, we're seeing that inflection, and asset markets respond to inflections in growth because they tend to be priced at the margin. So this is why that's important. And the reason for showing the central bank chart earlier is that just to say that what we're getting here is that the deterioration is coming fundamentally because of the private sector, not because of what central banks are doing. Now, why is the private sector deteriorating? Largely because money is beginning to move into the real economy from financial markets. Now, that's not necessarily only fueling real growth. It could be just basically compensating for higher inflation, or as we speak now, higher oil prices. But basically, all money that's anywhere must be somewhere. So if it's not in financial markets, it must be in the real economy, and vice versa. And that's broadly how the system works. So what we're facing now is tightening liquidity conditions, and that's basically a fact.
Housing analyst Melody Wright followed Ed, noting that credit is tightening up across the housing market as concerned lenders are increasingly cautious about making loans.
Yeah, and they're not tightening up because they're getting smart. They're tightening up because they are out of liquidity,
Yeah.
which is what typically happens. And also, your borrowers are in pretty rough shape. That's why the Fed recorded in, I think, October, the highest mortgage refinance rejection rate ever in their series, over 43%, which is just insane if you think about it.
Okay.
And
So the tightening is already starting, is what you're saying?
Yeah, it started really, I think, last October. And so, you've got that tightening, but I think people could still access like private markets, do these hard money loans and now there's like it's the personal secured loan, or buy now, pay later. But that's all tightening up too, because as these folks get into trouble, these private credit folks, and we're seeing their liquidity be constrained by what Chase just did.
Yeah.
They're not going to be lending out in the market. And this is going to hurt residential, but it's really going to hurt commercial, because your private credit was probably 20 to 25% of that activity last year. And they kind of had a mini origination boom, refi boom in the commercial real estate last year because of those actors. And they're now getting kicked out of the system. And so this debt maturity wall in 26 for commercial, this could be the first time we really have to deal with it.
Technical analyst Michael Oliver then walked us through his momentum charts that warn the stock market is at the precipice of a major multi-year bear market.
We're entering a major bear market. And if you go back through history, you see that those major bear markets are at least 50%ers, quite often a lot more. This is the biggest stock market bubble, fundamentally and technically, by our technicals, in history. It's vastly more of a bubble than the 29 top, or than the mid-73 top that collapsed into 74, or the 2007 top, or the 2000.com top. This is a much more aged, more bloated stock market than it's ever been. And momentum says, nope, you're no good if you break these numbers.
Stephanie Pomboy and Grant Williams joined afterwards to share their macro outlooks, laying out the possible cascade of asset price write-downs and debt defaults that could result if troubles in Iran and in private credit build from here.
The overarching question for me is the potential for this surge in oil prices on the back of the Iran action to precipitate some real risk-off mood in the markets as it sends interest rates higher, and we're already seeing the pressure in the private credit space. Does that devolve as a result of that? So that's sort of, I guess, my top overarching concern right now.
Brent Johnson followed, explaining how stablecoins are a true game changer to the monetary regime, one that will likely make his dollar milkshake theory even more compelling.
And that is, I think stablecoins have the potential to be as transformative to the global monetary system as when the United States cut the linkage to gold, 50 years ago, or 60 years, whatever the number is now. And it's because of, not because the dollar is great. I want to make that clear. It's not because the dollar is a great currency. It's because all other fiat currencies are even worse. And there's a large percent of people outside the United States who would much prefer to hold US dollars to holding their local currencies. And stablecoins make this infinitely easier to do, and it makes them infinitely easier to transport. You have seen in the last couple of weeks, with all that's going on in the Middle East, a rise in stablecoin usage and purchases in the Middle East and it's especially in places like Dubai and Oman because of what's going on over there. And so I think in many ways, before the actions took place in Venezuela, the Venezuelan economy was already very much dollarized. I think 70% of the economy ran on dollars already, and a big part of it was done via US dollar stablecoins. It's essentially a way for the United States to infiltrate any part of the world that has an internet connection, and have that infiltration be adopted willingly as opposed to being forced upon them.
Darius Dale offered one of the more optimistic outlooks of the day, noting that the impact of geopolitical events on financial markets are often short-lived.
Geopolitics in isolation historically has not been in much of a big, causal factor in trending market risk from the perspective of the momentum and dispersion within and across asset markets. What matters to the momentum and dispersion within and across asset markets are, trends in the 6 key macro cycles: growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. And so from the perspective of what's happened in the last few weeks that has caused this, risk-off market regime condition to emerge over the past few weeks is the fact that the spike in energy and the spike in the US dollar, both of which are broken out to bullish from the perspective of our volatility adjusted momentum signal. In fact, I can just show you quickly, walk you through those charts. In terms of what's happened, we got a bullish BAMS breakout in the US dollar from the perspective of our volatility adjusted momentum signal. We got a bearish to neutral breakout in the 2-year Treasury yield, a bearish to neutral to bullish breakout in the 10-year Treasury yield. We got bond market volatility broke out to bullish, currency volatility broke out to bullish. The equity volatility was already bullish. And so you've had so much negativity from the perspective of all these leading indicators of global liquidity suggest that if the war persists, then the probability that we have a trending decline in global liquidity is high.
Highly respected independent journalist Matt Taibbi then joined us to share his thoughts on the many ways that today's media is failing us as information consumers.
The media is broken, I think, in the sense that we're at a moment where nobody really knows what facts are true, how to check facts, how much to trust certain sources, and there are a variety of reasons that we're in this place. I actually started writing about this topic a long time ago. I wrote a book ages ago called The Great Derangement.
Judy, Shelton, and Danielle DiMartino Booth followed, sharing their thoughts on a Federal Reserve in transition and what they think of the newly appointed chair, Kevin Warsh. Judy minced no words for her frustration with the way the institution has been poorly stewarding our currency.
Even the 2% inflation rate that the Fed doesn't seem able to achieve, but would pat themselves on the back to achieve, is still deliberate debasement of the money unit of the United States. And I think it violates the constitutional authority of Congress to regulate the money. The money was meant to be an invariable measure, and the Congress's oversight in regulating the money is in the same sentence of the Constitution that gives Congress the power to define official weights and measures. It's not meant to be something that steadily reduces what it means as a measure. It's meant to be a monetary standard of integrity.
Right after that, precious metals analyst Andy Schectman made his case for why gold and silver are becoming quite oversold here and why he expects a recovery to new all-time highs for both metals lies ahead.
We see the price get smashed down, and then we see things like Chinese customs data showing 790 tons of silver reported in the first 2 months of 2026. February alone, 470 tons, the highest monthly import volume ever recorded. We see big deliveries on COMEX continuing to happen. And there was an interesting one in February that I found very, very interesting. And, in February, we saw about 28.5 million ounces that were delivered onto COMEX. Now, that doesn't mean that it left, right? 28.5 million ounces or so were delivered into COMEX, but then we saw at the same time 38 million, almost 39 million ounces leave COMEX in February, 160% of what deliveries alone would explain. You see some other very interesting things, and I don't know if you want to call it coincidence or not, but as I mentioned, we saw 38 million ounces leave COMEX, right? That means they were loaded out. That means if a mint box of Silver Eagles, which is 500 ounces, weighs 42 pounds, who in God's green earth is taking possession of between 38 and 39 million ounces, well over 2 million pounds?
We were then treated by Rick Roll to a number of his favorite stock picks right now, and how a world increasingly in competition with itself is suddenly creating a surge in appreciation of the essentiality of natural resources and who controls them.
The circumstance that you're seeing in the Gulf isn't merely a geopolitical contest. A geopolitical contest, how can you say? It makes things difficult. War makes things extremely difficult. And I think this war is serving maybe a useful purpose in the sense that it is pointing out to us the fragility that we're seeing on the supply side. It talks about the fact that we don't have very much surplus capacity.
Income and international investor David Hay came next, sharing a number of specific sectors and companies that he thinks have become quite attractive now that a panicked Wall Street has started to throw the baby out with the bathwater.
I do think that we've got a situation where there are some very intriguing opportunities that have been created not only by what's happening in the Middle East, but what's happening with AI. And we're not about to talk about it today much. We can if you want to, but also this private credit hysteria that's developed and opportunities that's creating. So there's definitely opportunities. There always are. And frankly, I think the more that you've got turmoil, the more opportunities you get. So the key points I'm going to cover, and I know we don't have a lot of time today compared to our usual type of setting, but I do think it makes sense to have an unusually high level of cash on hand right now. And I know it's not exciting to think about earning just 3 or 4%, but sometimes it's better not to lose money. And I say that realizing there are opportunities that I'm going to try to make a strong case for, but I do think that we're in this process where there's money moving out of the U.S. financial markets into offshore markets. And I know that's controversial, as we just talked about, but we'll get into some of the reasons why I think that's the case. And then, of course, the idea that AI will eat the world used to be software, now it's AI, but it has created this kind of throwing the baby out with the bathwater kind of scenario. And whenever that's the case, you've got some opportunities.
Then Lyn Alden, one of the top experts in the world on digital assets, gave her latest assessment and outlook for both Bitcoin and stablecoins.
So far this cycle, we had less of an up move in percentage terms compared to either the prior high or the prior low, depending on where you want to measure it from. And we don't know if this correction's over yet, but so far it's also been a shallower correction from its high than prior sell-offs have been. At the kind of the worst phase, it was about 50% down. Now it's less than that because it's bounced off those kind of recent lows. So it's still too early to say what this drawdown will be. I mean, I think there's a decent chance the bottom is in, but I wouldn't bet everything on that. But yeah, I do think that we are seeing a longer term slowdown in its volatility. Which you generally would expect. I mean, when it bootstraps from 0 to over $1 trillion, it's got to have a lot of upward volatility and to reach that kind of market cap. Every time you have upward volatility in an asset, you're going to get leverage and euphoria. So you're going to get periods of downside volatility. So those unfortunately kind of go together. But the bigger it gets, and the more it's kind of tied into institutional capital as well, in general, we should see less ability for one entity to move it around. We should see just higher liquidity, which kind of takes the edges off, generally speaking, on ups and downs. Less overall uncertainty, harder for governments to ban just due to the size of it. More people advocating for it in places where there's some degree of freedom of voting and capital and things like that. And so I do generally view this as another pretty garden variety sell-off.
The day then ended with an hour-long Ask Anything with Thoughtful Money's crew of endorsed financial advisors. All in all, the conference was over 11 hours long and delivered a wealth of actionable insights. But don't take my word for it. Here's feedback submitted at the end of the day by the conference attendees themselves. Flawless. Thanks, Adam. Awesome conference, amazing group of speakers, and a very good use of 11 hours. A heartfelt thank you to all the speakers and to you, Adam, for another superb conference. What an amazing lineup of speakers. If you're wishing you'd attend the conference but for some reason didn't, don't worry. You can purchase the replay video of the entire event, all the presentations and all the live Q&A sessions by simply going to thoughtfulmoney.com/conference. And despite inflation having raged over the past 2 years, we haven't changed the pricing of our conference in a long while. While I'm not certain yet if the price will rise for our upcoming fall conference, I'm giving you the option to buy your ticket for it now at 0% inflation. That is the same price as the one that we just did this past weekend. If you'd like to lock in your ticket now, you can buy it at the early bird price, our lowest and with no inflation from this past year, by going to thoughtfulmoney.com/fall. All right, now that the conference is over, I'm hard at work on a number of upcoming interviews I think you're really going to like on high interest topics like tax-free retirement planning, whether the US will really take Cuba, key learnings from the investment greats like Buffett, Lynch, and Templeton, and a number of others. You're going to find these interviews highly interesting and I hope highly valuable as well. I'll see you all then. And as usual, thanks so much for watching.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really irrelevant. As I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it, we have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold, Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay. Still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Ooh boy, you break through that and I'm gonna blow the cork off this thing." The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? Do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006, and it wasn't until late 2007 that the stock market finally topped, and it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals, okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, you know, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, you know, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. You know, as I said, your grandfather, father, and you, house cost, you know, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, no, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, you know, single-digit % still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I think China is going to shock the world, and the Chinese bond market is going to grow, and it's going to become the biggest as well. De-dollarization and the growth of the yuan, overseas yuan bond market, and that has been one of the linchpins, an overseas bond market for demand for the dollar. In London and in Europe, we've had what's called the Eurobond market, where dollars abroad are issued or lent to corporations. Australia's Fortescue said on Friday it had secured a yuan-denominated loan worth 14.2 billion Chinese yuan, $1.98 billion, to ramp up its decarbonization plans. I know I have an opinion about that, but I'm just trying to look at de-dollarization and the rise of the yuan.
China is positioning itself to shock the world by rapidly expanding its bond market, which could eventually rival or surpass the U.S. market, reinforcing the broader trend of de-dollarization. UBS estimates China's domestic bond market at around $25 trillion US, ranking among the world's largest. Beijing is also drafting new rules to strengthen cross-border yuan financing, making it easier for banks to support offshore yuan lending and bond issuance. Meanwhile, China is cutting its U.S. Treasury holdings, diversifying into agency bonds, gold, and other non-dollar assets amid rising geopolitical tensions. Now, yuan-denominated debt is taking on that role, as shown by Australia's Fortescue securing a 14.2 billion yuan loan to fund decarbonization projects. This shift highlights how the yuan is steadily gaining ground as an international financing tool, reducing reliance on the dollar. Mario Ineco, a former City of London bond trader turned independent financial analyst and commentator, points out that non-G7 nations have been working to reduce their reliance on the US dollar, not to replace it entirely but to gain more self-reliance, especially after years of US sanctions and political pressures. Much like finding a new bank when the old one becomes restrictive, these countries are building systems to trade and finance among themselves without always going through the dollar. While experts once argued it would take decades for China to become a major player due to its underdeveloped bond market, that is changing quickly. Overseas firms are increasingly issuing panda bonds, yuan debt in China, to access lower-cost financing and hedge geopolitical risk. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Countries, we're trying to basically become less dependent on the dollar system, not because they want to destroy the dollar, but because they want to be more self-reliant. They don't want to depend on the dollar alone. And one of the reasons for that, of course, has been the regime of sanctions and other political punishments by the US in the last 15 years. And it's akin to you having a bank account with a particular bank, and this bank starts making it hard for you to deal with them. Well, you're going to look for another bank. And I think the Global South, or the BRICS, if you want to call it, really, they're not really looking for another bank. They're not really looking for another reserve currency. They're looking for another system that they can deal amongst themselves, that they don't have to go through the US dollar, a third-party currency. And yes, back in 2017-18, when I started talking about this, it wasn't even on the radar screen, but now it's becoming more and more important. And what I want to talk about today is something about the bond market, which is a market that, of course, I worked in for over 20 years. It wasn't the corporate bond market, but it was the government bond market. But it's a very important market. The bond markets are the biggest markets out there. They're bigger than the stock market or the equity market. And I remember Jim Rickards actually talking about reserve currencies and whether the yuan or the Chinese renminbi would become a major reserve currency. I don't remember exactly how many years ago, maybe at least 5, maybe 7, 10 years ago, he said, yeah, China is not never, but he said it would take decades for them to really have a major part in the world's monetary architecture, trade architecture, because they don't have a bond market like in the US, a deep bond market, but that's also changing very quickly. China seems to do everything very quickly and very well, and I'm not defending China or its political system. I'm just looking at the facts, and that's what a lot of people have a problem doing. They get too bogged down in the politics and things like that, instead of looking at the numbers and the facts, of course. So I'm seeing a lot of stuff about China. For example, Vince Lancey posted this yesterday. Yuan bond growth. Countries are beginning to issue debt in yuan. Hungary's 5 billion yuan panda bond in July was the largest sovereign deal of its kind, while Russian energy firms are preparing yuan-denominated paper. So 5 billion yuan is under $1 billion. That's pretty small. But we're also seeing that other countries, and I think I spoke about this a couple of weeks ago or so, like developing countries, are swapping out of dollar debt to cut borrowing costs. And they're resorting to issuing Chinese yuan or renminbi bonds, or sometimes even Swiss francs, because they cost less.
Mario Ineco highlights that China's bond market is rapidly catching up with the US, now the world's largest at around $50 trillion, with China close behind at over $20 trillion and growing fast through government, policy, bank, corporate, and panda bonds. China's bond market is set to expand further as foreign demand for yuan bonds grows, with moves like Fortescue's yuan loans signaling broader adoption. Policy changes to ease cross-border financing show Beijing's commitment, while diversification away from U.S. treasuries may weaken global demand for dollar assets. As more countries issue debt in yuan rather than dollars, global demand for the dollar is set to weaken. Mario believes China's bond market could even overtake the U.S. within the next couple of years, further reducing the dollar's role as the primary reserve and payment currency, especially as Beijing continues linking the yuan more closely with gold.
I want to look at now is the biggest bond markets in the world and why China is really catching up with the United States. So I went to ChatGPT and I asked, what are the biggest bond markets in the world? And it says, just as I told you earlier, and this I knew, I didn't have to ask ChatGPT, it says the world's bond markets are massive, collectively far larger than global stock markets. The biggest ones are concentrated in advanced economies with deep financial systems. As of the latest available data, 2023-2024, the largest bond markets by outstanding debt securities are the United States, 50 trillion in outstanding debt securities. U.S. Treasury market alone is the most liquid and important benchmark globally for now, but corporate, municipal, and mortgage-backed securities are also make it enormous. Number two, yes, it's China, the second largest bond market, around $20 trillion plus dollars, driven by government bonds, central and local, policy bank bonds, and a growing corporate bond segment. Number three, lagging way behind, is Japan, 12 to 13 trillion. Euro area is around 20 trillion. But that's different countries, right? UK is 4 to 5 trillion. And I also looked at how the growth of the Chinese panda market, they call it the panda bonds. I guess it's foreign companies borrowing in yuan. That's been growing quite significantly since 2023, 2024. So it's really catching on. It says here, compared to 10 years ago, i.e. 2015, the market was much smaller. Precise data for 2015 may be less readily available in current sources, but the massive issuance in 2023, 2024, and the 1 trillion renminbi cumulative suggest a steep ramp up. So there you go. That's the panda bonds. Panda bond market. So all that's going to mean is that there's going to be less demand for dollars because, when you borrow in dollars, you want the dollars, right? So there's more demand for the currency. But if that's changing, and I'm not saying it's going to happen overnight, all these things kind of take a little while. As I said, I started talking about the demise, let's say, of the petrodollar back in 2017, and here we are 8 years later, and it's almost like complete, and it's accelerating, and the same thing's going to happen for the bond markets, and I think it could be a lot quicker than 8 years. We could see in the next year or two the Chinese bond market overtaking the U.S. bond market, and that, in my opinion, will mean that the dollar is going to continue to lose its status as the major reserve currency, even major reserve, a major form of international payment. And of course, I think China is making their renminbi kind of linked to gold a lot, and I'm going to talk about that, of course, with Eric Young. So look out for my interview with him about that. So yeah, let's quickly look at where the markets are this morning. It's 7:30 a.m. London time, so I'm quite early. Spot gold is pretty steady. It's basically unchanged here at 36.43. The low has been 36.26. The high 36.47. Silver is also unchanged, trading at 42.20. High's been 34, and the low's been just below 42. So very quiet markets so far. I expect they will get busier later on. I notice the U.S. Treasury yields, they're creeping up a little bit. The 30-year yield is back to 470. It's up 2 basis points. The 10-year as well is up 2 basis points at 408. Yes, it has come off a bit in the last week or two. And of course, the whole focus this week will be the Fed's decision on Wednesday. It's almost a done deal. They're going to cut by 25 on Wednesday. The news is coming out at 2 p.m. Eastern time or 7 p.m. London. The other thing to watch from that meeting is what they're forecasting, their dot plot chart going forward, and also the press conference. See what is said there by the chairman of the Federal Reserve. So the currency market and stocks are fairly quiet so far.
Will political and regulatory obstacles impede China's bond market growth, or may it eventually catch up to the United States within the next 10 years? If large economies started issuing the majority of their debt in yuan rather than dollars, how might the world's markets respond? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75. while the long-term targets of $20,000 for gold and $500 for silver remain highly speculative. Current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982, with the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end is going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982. And the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, "Oh, you've already pushed it out again." No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions in derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough,
Sure.
We didn't go through a bear market. So that's what's unusual. And I think that's where people are going to probably get it wrong is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run. And I'll be at that point contrary and saying, no, this is the top, we're close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative. And it comes, my reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global debt. And I realize a lot of it's sovereign, but 330 trillion in global debt and quadrillions in notional value of derivatives. Never been here before. Never. And derivatives are leverage on markets. Debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. From, it could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply. The mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years, whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, how might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.